Hi, welcome to this lecture on investment appraisal, the very basic introduction to the concept of investment appraisal. In this lecture, we are going to give a brief theoretical explanation of the concepts of investment appraisal. Then we will do some basic examples. But before I go further, let me share the screen that will be the worksheet for these illustrations to help you follow this lecture easy enough. I would like you to go to prof-emeritus.com. That's my web page. If you go to prof-emeritus.com, go to the subject area of financial management. When you just log or open the web page, you're going to find the subject areas: financial reporting and corporate reporting, financial management and advanced financial management. Under financial management and advanced financial management, click on that and you are going to find investment appraisal basic. You download the question that has been provided on that page. That will help you to follow the solutions. So instead of scrolling up and down to pick the figures, you will have the figure probably the question downloaded either printed, or you could be watching the solutions on your laptop, then the question is on your phone, and vice versa. So we're going to be doing just the very basic illustrations to lay foundation for what we're going to do in the next two videos. The second video is going to be on the same investment appraisal intermediate. Here we're going to introduce a little bit of complexities, and then we are going to go to investment appraisal advanced. By the time we are done with advanced, you're going to find out you don't have any challenge with this topic again. This might be roughly about an hour or some minutes over an hour. But if you stay till the end, it will be worth the time. And if you feel you just want to get maybe some complex areas of explanation, you could go to intermediate or advanced portion of investment appraisal. The same process you follow to download the question for this one is the same process you follow to download the question for the others. Then you can follow the explanation here on this YouTube channel. As you may have known, investment appraisal investment appraisal is part of capital budgeting. When organizations want to either change a line of business or they want to make their existing business more efficient and effective, or maybe cost effective, they choose to maybe invest in machinery or start a new product to expand their business. When they want to make this huge investment, normally they are concerned about whether the investment is going to be viable or not. And to test the viability of a project, there are methods that are prescribed in accounting for us to check if a project is going to be viable or not. But just a quick one before we even come to this place where we're going to check whether the project is viable or not. The board may have had a meeting and decided that, or let's take a look at whether this line of business is worth investing in. Should we take a new line of business? Should we invest in new machine? They would have sat down to decide on that. And after deciding that, okay, let's add a division, let's invest in new machinery or a new line of product. The next level will be to go to the finance department, for instance, and say, should we undertake this venture? Is it going to be viable, and are we going to recover the money that we put in this business at least? But you know that the ultimate goal of going into a business is for profit maximization, and the long-term objective is wealth maximization. We'll be talking about those ones as we progress. So back to where I was before. So there are methods that we will use to test the viability of these projects that we are going into. And as you've seen listed here on the screen, we have the accounting rate of return, which is also known as return on capital employed. Um, Return on capital employed is also known as accounting rate of return as far as financial management is concerned. But when we go to financial reporting, we will be looking at return on capital employed from a different angle, which will be calculation of accounting ratios. The next method is payback period, the net present value, internal rate of return, and profitability index. As we go ahead to calculate uh, or to solve illustrative examples, we would be able to explain a few of the methods in detail. But while appraising investments, the methods that have been stated here are divided broadly into two. The ones that use non-discounted cash flows and the ones that use discounted cash flow. When we talk about non-discounted cash flow, what we are saying basically is that these methods, they don't recognize the time value of money. Let's assume that you are putting $1 million in a business and it's going to take you 5 years to recoup that investment, maybe having $250,000 per year. These non-discounted cash flow methods look at it as if the returns, the value of $1 today is going to be like the value of $1 tomorrow. So they don't care about the effect of interest rate, for instance, or effect of inflation. And the methods that are under this category is the accounting rate of return and the payback period. Although in some scenario, the payback period would also fall under discounted cash flow methods. But in this video, I'm going to solve payback period under non-discounted cash flows method. However, if you are asked in an examination scenario to calculate a discounted payback period, you are just going to follow the process we are going to use in arriving at the net present value to work the payback period. It's not going to be something that is hard. So, but in an investment, two things are happening. The initial outlay, that is the cash you are putting in the business, which is cash outflow, and what you expect to generate from the business, which is cash inflow. But I want to start looking at the components of cash inflows. So if you were given an examination question, for instance, what would be the items that will constitute your cash inflows? You could be told that these are the cash inflows at once without mentioning individual items. But when we get to the complex part, the examiner will prefer to give you items that you need to sift the inflows by yourself and sift the outflows by yourself, just to test how you are conversant with this topic. But on a general note, as part of information that you need to gather before we continue on these lectures, you should know that sales revenue is cash inflow. When you sell and you receive money, that is part of an inflow. Cost savings is deemed an inflow in capital budgeting. For instance, if I have a machine in a manufacturing industry, maybe I make soap. So I have a machine that helps me to produce, let's say, 1 million tablets of soap a day. And then it takes me about 8 labor hours. I pay labor per hour. Um, then it takes me maybe 200-liter containers, 200 liters of diesel to run the machine. And I have a new machine that can help me make 2 million tablets a day of bars of soap. And it's going to take me just 5 or 4 labor hours a day. It means that the second machine is, and then I'm going to spend just maybe 100 liters of diesel to run the machine. I'm having cost savings from this new machine in two areas: from not paying for the second drum of diesel, which is 100 liters worth, and also for saving 3 hours of labor. And then I'm doubling my output in a day. So instead of buying two machines to give me 2 million tablets of soap in a day, I'm just using one machine that is doubling the output. So if I invest in this new machine, the cost that I save from not investing extra 3 hours per day in labor, and the cost that I save for not buying 100 liters of diesel per day, should be part of cash inflows. In your capital investment, apart from buying a machine, I might need to buy raw materials for the initial production, which is known as investment in working capital. When I make that investment in working capital, as you can see in outflow here, working capital requirement is cash outflow. But if I am going to release that working capital towards the end of the project back into the company, the release of working capital is going to be classified as cash inflow. If I have a salvage value, if the machine is supposed to last for 5 years, if that's the useful life of the machine, and at the end of the fifth of the 5 years, I would be able to sell the machine for a scrap value instead of disposing the machine for free or paying people to come scrap it and remove it from the company. And I will sell it to another person who is willing to use it. The income I'm going to generate from selling the machine is the salvage value. Cash outflow is the initial amount of capital that I'm investing to buy the asset or to get into a new line of business. Working capital, as I've explained before, what I'm investing in working capital at the beginning of the project is cash outflow. If I'm going to incur future major expenditure, let's assume I have a machine that a certain component of it needs to be changed, let's say every 3 years, and this machine is supposed to last for 6 years. And the changing of that component will, extend the useful life of that machine. That becomes a future major expenditure related to this project or this machine. That is to be calculated as cash outflow. Having known what should come under cash outflow and cash inflow, these are the very basic, it covers about 99%. As we proceed, we will know whether we're going to integrate one or two more items into the components of cash inflows and cash outflow, like as the concept of opportunity cost. But I'm not going to mention that one now until when we get to the second part of the video, when we have a little bit of more complex illustration. But relevant cash flows. Before I recognize any item under cash inflow or cash outflow, those costs must be relevant. And how do I measure the cash flows that are relevant? The cash flow must be incremental. It means that it should be additional. Let's assume I'm buying a new machine. I am adding a new line of business. I'm adding warehouse. I'm adding building. It means that because of this new project that I am undertaking, I am going to spend an additional capital. It's not what I have already invested in the past and the business is ongoing or continuing. Is what I am going to spend in addition to what I have done before, probably to make the company more efficient. The cash flow must be futuristic. It's what I plan to spend in the future, not what I have spent before. And that cash flow must be avoidable. Don't forget that the relevant cash flow covers especially cash outflow. Avoidable here means that if I do not undertake this project, I will not need to spend this money. So that is how to measure relevant cash flow. So before you include cash flow in these two components, is it incremental? Is it futuristic? Is it avoidable? We will explain this avoidability concept in addition to opportunity cost in the second video, and also give an illustrating example. And some of these will affect components of cash inflows. But which cash flow should not be relevant? Which one should we ignore? Sunk cost. Cost of investment that has happened in the past. The business is continuing. And the fact that whether I undertake this new venture or not, this cost is already incurred and I cannot change it. Example, if I have a warehouse that is twice the capacity of my product, but I have paid for capacity of my machine, what my machine is producing currently for my business. I need to, and I have already paid for it. If I am extending the business by buying a new machine, I cannot carry the costs, include the cost of the portion that I'm not utilizing currently as part of the cost of the new investment. It is past investment in fixed asset that has already been done, that is not part of this new investment, a sunk cost is past. Then apportioned costs. This cost that I should recognize should be directly attributable to this investment, not the ones that are apportioned. And in this place, the main culprit here is overhead. So we would ignore overhead at all levels when we are getting into the solution involving investment appraisal. So unavoidable cost here means that whether I undertake this new venture or not, I'm going to incur these costs. So we will, it's an irrelevant cash flow and it should be ignored. So I have just given a synopsis of which methods we have, which ones uses non-discounted cash flow, which one uses discounted cash flow. The discounted cash flow technique takes into account the time value of money and say $1 today is bigger than $1 tomorrow. So if I'm going to receive $1 tomorrow, what is the value as at today? So all these are just to prepare our mind. The illustration, as we are getting into it, we will re-examine and explain all these concepts in details as we progress. So based on that, we will take the first illustration. Don't forget that this is very basic and we will just try our best to keep it simple, you know. A&S Limited is considering an investment. I assume that at this time you already have this question in another device or you've downloaded and printed it, because by the time I pass this place, I won't be coming down here to be looking at the question before we solve. I will just go ahead and be rolling out the solution based on the question that I have in a backup device also at my disposal. So A&S Limited is considering investing in a new machine and has identified two mutually exclusive options. You've been provided with the following information: machine X and machine Y. Investment is 45 for machine X and 60 for machine Y. They have a scrap value and the life of the machine is 5 years. These are the annual cash flows. Loss in year one for both machine. Year two, losses for both machines. Year three, they are in profit. And estimated evaluate all investment of this nature using the discount rate of 12%. Let me just explain something here briefly before we proceed. At some time as you progress, you are going to find videos on cost of capital, which will explain this in details. But for now, it's still worth it to mention the fact that the discount rate that is chosen by a company is based on two factors. Let's say, for instance, I have money in a fixed deposit account and it returns 6% per annum, and I need to make an investment. I will choose a discount rate that is above 6%, meaning that since I currently earn 6% from my investment in fixed deposit, if I'm taking that money to make an alternative investment, I should earn something more than that six, or the minimum that I can accept is 6%. Then that is when I have the cash and it's already invested in another place generating income. However, if I want to borrow the money, if I'm borrowing the money at a rate of, let's say, 10%, I will choose a discount rate that is either 10% or above 10%, meaning that that's the minimum that I want, so that I'll be able to pay back the interest on the borrowing and then also be profitable. Annual cash flow figures exclude straight line depreciation on the machines. Required. For each machine, calculate the accounting rate of return, the payback period, the net present value, and the internal rate of return, IRR. B. Based on your calculation above, determine which of the two machines, if any, should be purchased. State your reasons. We are just going to do just that, and we will state our reason. So, believing that you already have the question downloaded from prof-emeritus.com, let us go now and look at the solution. So we're going to start with machine X, and we'll be looking at the accounting rate of return. I will just insert table, and I'll look at my year. I look at cash flow. I look at profits. Then I go on 5 years. So I make it 6 or 7. So I have, sorry, I should insert it here where the solution is. So I have years, I have cash flows, I have profit. There's something I'm doing here for accounting rate of return. Accounting rate of return uses accounting profit. It uses profit. It does not use cash flows. In other words, it uses cash flows less depreciation to give us accounting profit. So in an examination situation, if you are given profit for accounting rate of return, you use it straight ahead. But if you are not given profit, but you are given cash flow, you need to convert the cash flow to profit before you can calculate accounting rate of return. For years, we use year 0 as the first year to reflect the first year that we made the investment in capital, and then we proceed. Cash flows, as you see from the question that you have, don't forget that we're looking at machine X. Cash flows, we have outflows, we have 45,000. Cash outflow is in negative, and then if you made a loss, it's also negative. So we have a 3,000. Then the second year we made a loss also of 1,000. So though the question has said pounds, but I just want to change it to dollars to make the currency symbol a little bit more universal, because that is what most persons will find in their professional exams. 14,500 is the profit for the third year. The fourth year is 38,000, and the fifth year is 45,000. Now, because I need to convert the cash flows to profit, I would first of all have to calculate depreciation. And the depreciation is the life of the machine is 5 years, and the depreciation is calculated on straight line basis. So I'm going to look at annual depreciation. The annual depreciation would be the cost minus scrap value, which is 4,500 divided by the number of years, 5 years. So I'm going to have 45,000 minus 4,500. That gives me 40,500 divided by 5. That is 8,100. So annual depreciation is 8,100. So the cash inflow rather. So I'm going to have, I had a loss in year 1 of 3,000, and I'm going to less depreciation of 3,000. So that increases my loss to 11,100. Take note that annual depreciation is 8,100, so I'm going to use it to affect these individual figures. I have this for year 1, a loss of 1,000 plus 8,100, that is going to be 9,100. I have a profit of 14,500 minus 8,100. That gives me 6,400 positive. I have 38,000. I'm going to take away 8,100. So 38,000 plus 8,100. That will give me 29,900. Then I have 45,000 in the last year. That will be 45,000 minus 8,100. That gives me 36,900. 36,900. Having obtained the profit figure, I am going to state the formula for calculating accounting rate of return. There are two. For ACCA exams, for instance, you'll be told which methods to use. But if you are left open to which method to use, I was supposed to state 3, but let me just state the 2 that are used most often. If you use that, then you state the formula. The first formula that we will consider is average profit all over initial investment. And the second formula, that will be multiplied by 100% anyway. And the second formula is average profit all over average investment. If we are following the second formula, simply average investment is initial outflow, which is 45,000 in this case, plus scrap value of 45 divided by divided by 2. But we are going to be using average profit all over initial investment. If you look at this table that I have created, I have left this place for initial outflow blank. I have a reason for doing that, because it's not going to hold water in this. If we are looking at cash flows, then it's going to be important to us, and I'm going to explain it as we get into the next method, which is a payback period. And then in the introductory part of the class, I said that the scrap value is considered as cash inflows, but I've also ignored it in this place because here accounting rate of return uses profit. So the scrap value is not a profit per se. It's not a trading profit. It uses accounting profit. So the scrap value is not part of the profit that is considered. That is why I am not considering it. So accounting rate of return here will be 11,100 plus 9,100 negative plus 6,400 plus 29,900 plus 36,900, all divided by how many years do we have? 1, 2, 3, 4, 5. So the number of years that we were accruing this profit is 5 years. So what will be our average profit? Let me put it to calculator. Minus 11,100 plus, that'll be minus 9,100 plus 6,400 plus 29,900 plus 36,900. That gives me 53,000 divided by 5. That is 10,600. So my average profit is 10,600. Remember that I said we are not going to be using average investment, so we are going to use initial outlay. So in this case, my ARR slash ROCE is going to be 10,600 divided by initial outlay is 45,000 multiplied by 100%. So that will be divided by 45,000 times 100. That's 23.5%. That's approximately, if we rounded it up, that is going to be 24%. So the accounting rate of return is 24%. So remember, we were given cash flow. We've converted it to profit because accounting rate of return uses profit and not cash flow. And that is the only investment appraisal technique that uses accounting profit. So what would be the advantage of using accounting rate of return? Number one, as you've seen, it's very simple to calculate. It's also very simple to explain to management. It can be related to many other methods of project evaluation in accounting, especially when we look at ratio analysis for financial reporting. You can link it to the other measures of profitability. So, what will be the major setback for using accounting rate of return? We've seen that here already. We've stated two methods that we can use to calculate accounting rate of return. So depending on which method you use, it means that the results are going to be different. That's a setback. It uses profit. So, and there are subjective approaches adopted by businesses in arriving at annual profit. So depending on which method uh, of which approach of recognizing revenue that a company has, you might find it difficult to compare the accounting rate of return across industry or businesses. So, and this rate is highly subject to manipulation. Another setback is that it does not recognize the time value of money. Okay, this another advantage you mentioned. It recognizes the profit for over the life uh, span of the project. So that's it. Remember, we are in the basic component of this class, and so we are just matching on for the moment. Payback period. Payback period uses cash flow. So we are going to use cash flow the way we have been given. So I go to insert this. Yes. Um, and I have yeah, just make it as much as I can. So payback period. As we get to machine Y, I'm going to make it more simplified. I will use just one table to finish everything. For now, I didn't want to complicate issues to explain each method easily. That is why I yes um, cash, cash flows. This this next line is not next column is not necessary anyway, but I'm just putting it for the purpose of understanding. 1, 2, 3, 4, 5. From the question that you have, you know that cash outflow is 45,000 negative. We're evaluating it in dollar terms. And then first year profit was 3,000 negative. Second year profit was 1,000 negative. Third year profit, according to our question, is 14,500. Next year profit is 38,000. And the next is 45,000. And I'm having this same year 5. I'm going to have a residual value. Since it is cash flow, I'm going to recognize the scrap value of 5,000. So, sorry, the scrap value is 4,500, not 5,000. So I'm having 4,500. Cumulative cash flow, I have 45,000 negative. Outflow, since I have a loss again in this place, I'm going to have 48,000 negative. Since I have a loss again of 1,000, I'm going to have 49,000. Yeah, at this place, I've started making profit. So if I have minus 49,000 plus 14,500, I have 34,500 negative, 34,500 negative. The next year I have profit of 38,000. So if I take it out of there, I have 3,500 positive plus 45,000. I have 48,500 positive plus 4,500. I have 53,000 positive. For payback period, payback period simply asks me at which point in time am I going to have money that is equivalent to the 45,000 that I invested initially. So just look at this place. So year 0 is a cash outflow. In year 1, I had nothing positive coming in. In year 2, I have nothing positive coming in. So year 1 and year 2 have passed. I still have not gotten my 45,000. Instead, I have 4,000 in loss. So I say that 4,000 plus 14,500 as at year 3, I will recover 10,500. How did I get 10,500 in this place? That would be negative 4,000 plus 14,500 positive, and that gives me 10K5. That gives me 10,500. That gives me 10,500 positive. So since I have 38,000 here, if I add 10,500 to 38,000, I'm going to have 48,500. So obviously in the fourth year, I've already had more than what I am looking for. So how do I calculate my payback period? Year one, I don't have what I need. Year two, I don't have what I need. In the third year, I have only been able to recover 10,500. So in a whole 3 years, I have not been able to recover anything. So I'm going to say 3 years plus something. In the fourth year, I don't need the whole of the 8,000 to make 45,000. So I ask myself, if I have 45,000 to recoup, and I now have 10,500 in the third year, how much more do I need from this income in the fourth year to make my 45,000? So I'm going to say 45,000, which is my initial outlay, minus 10,500, which I've already had as at the third year. It means that I need additional 34,500 to make up 45,000, because payback period is simply saying at which year am I going to recover the exact money that I invested in this business at the beginning. So how do I calculate it? I say 3 years plus 1, 2, 3. I've not been able to get the 45,000, but I got 10,500 positive in the third year. So how do I do? I now say 3 years plus 34,500, which I need now. I need only 34,500 from 38,000. So if I say 34,500 divided by 38,000, that is this portion alone. This portion alone gives me 0.91. If I'm approximating it to 2 decimal places, 0.91. So for me to convert it to months, I'm going to say that multiplied by 12. That gives me 10.8. So I'm going to say 3 years 11 months. I have 10.8. Even if I have 10.1, I will round it up to the next month, unless I have 10 on the dot. If I have 5 on the dot, it's just say 3 years and 5 months. But here, I need 3 years and 11 months to be able to recoup my investment. You want to rewind that place back if you didn't get it properly and watch it again so that you find out how we do it. But don't forget that we have the next machine ahead of us to use. That's machine Y to use and get additional knowledge on how to derive all of these um, methods that we've mentioned before. For net present value, we are going to get figures that we are still going to be using to calculate the internal rate of return, and that will wind up the first part of this, and we are going to now go faster when we go to machine Y, because everything we're going to do it in a single table. So I will still insert my tables. In this case, I have my years. I have cash flow. I have discount factor. I have present value. I have discount factor. I have present value. Then I have my number of years. So net present value approach. I would have left off at just solving machine X and ask you to do machine Y, but because I have used different tables, which I think takes a longer time because I needed to explain some concepts, let me just go to machine Y again and then use maybe 10 to 15 minutes and solve everything together, and then we wrap it up. So we have years, we have 0, we have 1, 2, 3, 4, 5. So sorry, cash flows, discount factor, we're writing it as DF. They use discount rate of 12%. Present value, I've represented it here as PV. If we want to do the internal rate of returns, normally internal rate of return requires you to get a low NPV and a high NPV. If your first NPV is positive, the next rate should be a smaller or a lower rate. For instance, if we use the discount factor of 12%, and at the end of the day, we get a discount, we get a net present value, the addition of all this minus initial outflow, that is negative. When we come to this next rate, we're going to use a lower rate, let's say 6. But if we have a positive NPV in this place, normally we should use a higher rate. If this was 10%, to give me a higher rate, normally I double it and make it 20%. This is 12, but I will still make the next rate to be 20%. I'm going to re-explain that. Now, internal rate of return requires that I have 2 discount factors and I have 2 rates. Two NPVs. 2 NPVs and 2 rates. So one negative one positive, or one high and one low. In an exams, if you use the next rate, let's say you decided to use either 15 or 18%, and you had positive here and you had another positive here, there's no problem. It mustn't be positive and negative. It should be a higher rate and a lower rate, but preferably you should have a positive NPV and a negative NPV. So in this scenario, I'm assuming that I'm going to have a positive NPV. That's why I have doubled or almost doubled the rate. I've made the higher rate to be this. So cash flows, I have 45,000 negative. I have 3,000 negative. I have 1,000 negative. I have 14,500 positive. I have 38,000 positive. Have I'm supposed to have 45,000 as the last rate, but because the residual value is 4,500, I am going to make this 49,500. That is cash flow of 45,000 at the fifth year plus the 4,500 scrap value. I can as well make 2 years 5 and put 45,000 here and put 4,500 here, but I don't want to do that. Discount factor at 12%. There's something I'm going to do when we get to the next video, which is the intermediate level. I will show you how to use calculator and get it. But in exams, both at the university level and at the professional level, they are going to give you the discount factor or the present value table. Remember that we said accounting rate of return and payback period, they use non-discounted cash flows. But other methods, internal rate of return, net present value, they use discounted cash flow. This method simply says that cash flow today is bigger in value than the cash flow tomorrow. So if I'm going to have returns by tomorrow, I should discount it to today and find out what is the value. So I'll be saying something more about this when we get to the next video. But for now, we have a present value table, which I'm going to show you here. So this is the present value factor table. If I was looking for 10% year one, this is it. Year two, this is it. But I'm looking for 12%, which is actually under here. So the present value table is also uploaded for you to download. That's what I forgot to mention earlier. So you need to download the present value table, and then we are going to use it here. So so 12% at, so discount factor at year 0 is always 1, irrespective of the rate that is used. So for year 1, I have 0.893. Year 2, I have 0.797. Year 3, I have 0.712. Year 4, I have 0.636. Year 5, I have 0.567. That's at 12%. At 20%, year 1, I have 0.833. Year 2, I have 0.694. Year 3, I have 0.579. Year 4, I have 0.482. Year 4, I have, year 5, I have 0.402. So what I need to do now is to multiply this cash flow by this discount factor to give me the present value. So since the present value of year 0 is 1, meaning $1 today is $1. So I'm going to say 45,000 is still 45,000 negative. So I have 3,000 year 2 multiplied by 0.893, that is 2679. 2679. 1,000 multiplied by 0.797, that is 797. 14,500 multiplied by 0.712, that gives me 10,000. 10,324. I have 38,000 multiplied by 0.636. That gives me 24,168. I have 49,500. 49,500 multiplied by 0.567. That gives me 28,067. 28,067. How do I get my 28,067? How do I get my net present value? So my NPV, net present value, is the addition of the positives minus all the negatives. 28,067 plus 24,168 plus 10,000 324 minus 797 minus 2679 minus 45,000. Just a moment. 28,067 plus 24,168 plus 10,324. Yeah, we're going to subtract 797. We will take off 2,679. So 2,006. We're going to take off 45,000. That is 14,083 as the NPV. 14,083 as the NPV. Now, for the net present value, this is all you are required to do. You don't need to use two discount factors. But because we need to do internal rate of returns, I just want to use this single table to take care of internal rate of returns. That is why we are doing it. So I'm still going to multiply the original cash flows by this discount factor. And since the discount factor for year 0 is 1, I'm still going to have my 45,000 brought out here. I will have a negative here. I will have a negative here. So I have 0.833 times 3,000 negative. That gives me 2,499 negative. 2,499 negative. I have 694 negative. Oh, sorry, not that. Yeah, 694 negative. Then 0.579 multiplied by 14,500. That gives me 8396. 8396 approximately. I have 38,000 multiplied by 0.482. 38,000 multiplied by 0.82. That's equals to 18,316. 18,316. Then we have 49,500. 49,500 multiplied by 0.567. No, 0.402. 49,500 multiplied by 0.402. That gives me 19,899. 19,899. All the positives less all the negatives. So 1218 316 plus 19,899 plus 8,396 less 694 less 2,499 less 45,000. We have 1582 negative. 1582 negative. So we've achieved our objective of having two discount factors, obtaining a positive NPV, and then also obtaining a negative NPV. With that, we are now going to calculate our internal rate of return. This formula simply says RA stands for the lower rate, which was 12%, plus the NPV of the lower rate all over NPV of the lower rate minus NPV of the higher rate multiplied by NPV of the higher rate less NPV of the lower rate. What do I mean? What was the lower rate in this place? 12%, which we can say 12. So if I use them as absolute, when I get the final answer, there's no need to multiply by 100. But if I use them as decimals, if I express them in percentages, when I find the final answer, I have to multiply by 100. So let me say 0.12, that's representing the lower rate of 12%, plus the NPV of this lower rate was 14,000, 083 positive, divided by NPV of the lower rate, which is 14,083 minus the NPV of the lower rate. So since the NPV of the lower rate is negative, the minus that is a default in the formula plus this other minus gives us a positive. So we're going to say plus. Minus gives us a plus. That's why we're going to say plus. Sorry, NPV. It's not what I should have done here. That's it. Divided by that plus 1582. Don't forget that if this NPV was also a positive, sorry, the internet just tripped off. I guess it's because of the length of time that we've used. So multiplied by the lower rate which is higher rate, which is 0.20 minus 0.12. That's it. So if you have a scientific calculator, you just type all of that like I want to do into the formula and into the calculator, and I'm going to get the answer 0.12 sorry, 0.12 plus 14,083 into 14,083 plus 1,582 . Then multiplied by 0.20 minus 0.12 equal to times 100. So this is going to give me an internal rate of return of 8.2% approximately. So that is what you are going to have from the internal rate of returns. And that is how far we've come with machine X. Then for machine Y, which we are going to do spending a lot of, not as much time as we spent before, we will use one table. And when we are done with that one table, we'll answer all the questions. So I'm going to insert so I have my years 0, 1, 2, 3, 4, 5. I have my cash flows. The cash flows for machine Y, year 0 is 60,000. Year 1 is 5,000 in a loss. Year 2 is 1,000 in a loss also, just like machine X, machine Y. Year 3 is 35,000. Year 4 is 40,000. Year 5, I'm going to put 50,000. Sorry, 50. It has a scrap value of 6,000, so I'm going to put 56,000. Then I have my profit. You want to watch what I want to do now very carefully. Before I can establish my profit, I need to take away my depreciation, which is 60,000 minus 6,000 divided by 5 years. Give me 54,000 divided by 5. Annual depreciation is 10,800. Why do I need profit? Because I need to calculate the accounting rate of return. So 10,800 negative plus 5,000 negative is 15,000. 15,800 negative. We have 11,800 negative. We have 35,000 minus 10,800. That gives me 24,400 positive. 40,000 minus 10,800. That gives me 29,200 negative. Then don't forget that I'm not going to use 56 minus 10,800. I'm going to use 50,000 minus 10,800. Why I'm using 50,000? Because that's the original cash flow. But this other 56,000 includes 6,000 scrap value, which is not going to be useful to us when we're calculating accounting rate of returns. Okay, so that gives me 39,200. Then I look for my discount factor at 12%. I look for my present value. I look for my discount factor at 20%. Then I look for my PV. So I guess I need to take all these, delete columns. Good. So I have the opportunity to expand these other ones. PV. So discount factor at year 0 is 1. Present value at year 1. Value of the outflow 60,000. Discount factor at year 0 is 1. Present value at year 0 is equal to the volume of the initial outlay. So go back again to our discount factor table. We have 0.893, 0.797, 0.712, 0.636, 0.567. I come to 20%. I have 0.833, 0.767, sorry, 0.694, 694, 0.579, 0.482, then we have 0.402. Remember that I need to calculate the accounting rate of return, the payback period, the net present value, and the internal rate of returns. But I'm not going to use just a single table to run all that. This is what I would have done from the beginning, but I decided to take them individually just to help you. So that, but if you are in an exam situation and you need to calculate all those methods, you just use a single table like we have here, and that will take care of everything that you need to calculate. So remember that I'm not going to multiply profit by present value. I'm going to multiply cash flow by present value. So I have 0.893 multiplied by 5,000 negative, negative, negative. So this will give me, this is going to give me 4465 negative, 797 negative, 35,000 multiplied by 0.712 is a 24,920, 24,920. We have 0.636 multiplied by 40,000. Remember, it's against cash flow, not against profit. That will give us 25,440, 25,440. Then we have 56,000, that is 50,000 plus the 6,000 residual value multiplied by 0.567. That gives us 31,752. So we come to this place, 0.833 multiplied by 5,000, still against the negative cash flow for year one. That gives us 4165. We have 694 negative, 35,000 multiplied by 0.579 is 20,265. 40,000 multiplied by 0.482 is 19,280. 402 multiplied 0.402 multiplied by 56,000, that is 22,512. Then we find the net present values, NPV, NPV. All the positives less all the negatives. So I'm going to say 31,752 plus 25,440 plus 24,920 minus 797 minus 4465 minus 6123. That is 16,850 positive. 16,850. This is measured in dollar terms. Measured in dollar terms. Measured in dollar terms. Measured in dollar terms. So the second NPV is minus 60,000 minus 4165 minus 694 positive 2265 positive 19,280 positive 22,512. It gives us a negative NPV of 2,802. Having done this, we proceed to our solutions. We have ARR, that is equal to average profit all over initial investment. So we have brackets plus brackets. So we have 15,800, 15,800, 11,800, plus 24,400 plus 29,200 plus 39,200 divided by 5. Sorry, this is average profit, not ARR. Average profit. So let's look at what it is. Minus 15,800 minus 11,800 positive 24,400 positive 29,200 positive 39,200. That gives me 65,200 divided by 5. That gives me 13,040. 13,040. So ARR is equal to 13,040 divided by 60 1000 multiplied by 100%, divided by 60,000 multiplied by 100. 13040 divided by 6123 multiplied by 100, 21.7%. So that we will now look at the payback period. We can't get our money back in year one. We can't get it in year two. We can't get it in year three. So let's see what it is. By year two, we already have 15 minus 15,800 minus 11,800 gives me 27,600 negative. By year four, I have 24,400 positive. By year four, I still have 3,200 negative. By year three, I have 3,200 negative. By year four, I have 26,000. I have 26,000 positive. So I'm going to have 4 years plus. So if I have 26,000, how much more do I need to make it 60,000? So I say 60,000 minus 26,000. I need 34,000. So I need 34,000 out of 39,200. So I'm going to say plus 34,000 divided by 39,200. How did I get 34,000? I have 60,000 minus 26, which I already have in hand at the end of year four. So I'm now going to the fifth year. So divided by 39,200, that gives me 0.86. So this place alone gives me 0.87 to 2 decimal places. So how do I get the number of years? So I'm going to say 4 years. And I multiply this 0.67 by 12. And that gives me 4 years and 11 months. Because it's 10.4, so I approximate it to 11 months. NPV, I already have it, which is copy and paste. So NPV is 16,850. So you see that if I didn't follow the first approach, which I did for ease of understanding, we would have finished a long time ago. So subsequently, when we have examples that are mixed, we will not be treating them individually. We'll just use a single table, and then with that single table, we answer all the all the questions. So with that, we now need the IRR. I'll say lower rate, which is 0.12, that is 12%. 0.12 plus NPV of the lower rate, which is 16,850 divided by 16,850 plus 2,802. If this second NPV was positive, I would use minus because the formula says minus, but minus here is plus. All of this should be multiplied by 20.20 minus 0.12. I'll put the whole of that in my scientific calculator and get the answer. If you don't have a scientific calculator, it's always preferable to get this one in bracket, multiply it by this other bracket, then you add it to this 12. So we have let's stop it. So I'm typing this to my calculator. 0.12 plus 16,850 into 850 plus 2,802 multiplied by 0.20 minus 0.12 times 100. So we have 7.8%. So we have come to the end of the requirements. When we go to the second video, then we look at profitability index, which is pretty easy anyway. But for now, for the first machine, we have the accounting rate of return to be 23%. The second machine, we have 21.7. We have the payback period to be 3 years and 11 months. Machine Y is 4 years and 11 months. The net present value positive for machine X is 14, while machine Y is 16 plus. The internal rate of return is 8.2, and the internal rate of return here is 7.8. So if you are looking at accounting rate of return, payback period, and internal rate of return, the 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 company should choose project X. But if you are looking at the net present value, the company should choose project Y. That's machine Y. Overall decision. So in an exam situation, you are going to say the way I'm saying that if you were looking at accounting rate of return, payback period, and internal rate of return, project machine X is preferable to machine Y. But based on the net present value, machine Y is preferable to machine X. Overall, the company should invest in machine Y because it has the highest NPV. So the most valuable of all the methods here is the net present value because it maximizes shareholders' wealth. So that is the final decision that you're going to take. Thank you so much for staying this long to the end of this video. Hope it was helpful. See you in the second video, which will not be as long or as lengthy as this because we are going to be combining one table to answer all the questions. Thank you very much and thank you again. See you in the next video.